Every day, millions of retail investors enter the market with the hope of making quick money, building wealth, or finally beating the system. They check stock prices, crypto charts, and investment forums, dreaming of the big win. But the harsh truth is that most retail investors lose money. And the reasons are more predictable than you might think. The first reason is information imbalance. Large institutions, hedge funds, and professional traders have access to research, analytics, and market intelligence that the average retail investor simply cannot match. They know trends before they happen, they understand insider risks, and they can predict market movements with tools that retail investors rarely have. Meanwhile, retail investors often rely on social media hype, news headlines, or tips from friends. By the time they act, the market has already moved, and it usually moves against them. The second reason is emotional trading. Markets are volatile, and emotions are dangerous. Fear and greed drive most retail investors' decisions. When a stock or crypto suddenly rises, FOMO, fear of missing out, kicks in, they buy at the peak. When the market drops, panic selling follows, locking in losses. Emotional trading replaces strategy, and in investing, emotion is the enemy. Every impulsive decision costs money, even if it feels thrilling in the moment. Another reason is chasing trends and hype. Retail investors are often drawn to viral stocks, trending cryptocurrencies, or hyped-up IPOs. They buy because everyone else is buying, believing the price will continue to rise, but markets are unforgiving. By the time they join the hype, large institutions have already taken profits, leaving retail investors to catch the falling knife. Meme stocks, viral coins, and hot tech IPOs are classic examples of hype-driven disasters for retail investors. Lack of strategy and patience is another trap. Professional investors approach markets with long-term plans, risk management, and calculated positions. Retail investors often have no plan. They trade impulsively, chase short-term gains, and constantly switch investments. Short-term thinking may feel exciting, but it rarely leads to consistent profits. Without a disciplined strategy, retail investors are almost guaranteed to underperform. Fees and hidden costs also add up. Every trade comes with fees, commissions, and taxes. For frequent traders, these small costs compound into significant losses over time. Institutions pay lower fees and can absorb market fluctuations better, while retail investors feel the cost in every trade. Market structure itself is stacked against retail investors. Large players use algorithmic trading, high-frequency trading, and advanced analytics to move faster than human traders. Retail investors often compete unknowingly against these systems, reacting too slowly or too late. The result: buying high, selling low, and losing money repeatedly. Another challenge is behavioral bias. Retail investors often overestimate their knowledge and underestimate risks. They fall for confirmation bias, only listening to opinions that support their views. They follow the herd, believing the crowd knows better. These biases lead to repeated mistakes, magnifying losses over time. Even when they try to diversify, behavioral errors reduce effectiveness. Selling winners too early and holding on to losers too long is a common pattern. Chasing short-term trends instead of following a long-term plan prevents portfolios from growing steadily. Timing also matters. Many retail investors enter markets too late, after prices have already spiked. They buy at the top, expecting prices to rise further, only to see them crash shortly after. Without patience and awareness of market cycles, losses become almost inevitable. Overconfidence is another hidden trap. Many retail investors think investing is easy or that they can outsmart professional traders. They ignore warnings, skip research, and act as if luck is enough. But markets are complex, and overconfidence often leads to catastrophic mistakes. History is full of stories of investors who believed they were smarter than the system, only to lose everything. Even experienced investors are not immune to unexpected events. Regulatory changes, security breaches, economic shocks, or sudden large trades can trigger rapid market swings. Those who are unprepared or emotionally attached often panic and sell at the wrong time, reinforcing the cycle of losses. Despite all these challenges, losing isn't inevitable. Retail investors who educate themselves, maintain discipline, avoid emotional decisions, and stick to long-term strategies can succeed. Knowledge, patience, and risk management are critical. Understanding market cycles, studying investment fundamentals, and following a plan are the keys to avoiding the pitfalls that trap so many beginners. The reality is that the financial system favors those with information, discipline, and access to resources. But retail investors who commit to learning, controlling their emotions, and acting strategically can still compete. Success is rarely instant. It requires patience, preparation, and smart decision-making. If this story helped you understand why retail investors often lose money, take a moment to subscribe to the channel. More deep dives into market psychology, investing mistakes, and strategies for success are coming, and you won't want to miss what happens next. Remember, knowledge, preparation, and discipline are your first steps to turning the odds in your favor.